Welcome to this Market Structure Masterclass. This quick lesson is created for beginner traders, especially those who feel confused when they look at charts. This is for the trader who wants clarity, direction, and confidence. Most beginners believe trading is complicated. Too many indicators, too many candlestick patterns, too much noise. But the truth is simple. The market has a language. A simple language. And that language is market structure. When you understand it, everything becomes clearer. You stop guessing. You stop panicking. You stop chasing candles. You begin to see the real story behind every move. By the end of this masterclass, you will understand trends, structure breaks, liquidity, entries, exits, and how to read a chart with zero confusion. If you want to see this lesson come alive with charts, examples, and step-by-step visuals, check out the full video lecture. The link is in the description, and it'll take you straight there. Watching it will make everything even clearer and faster to understand. Don't miss it. So take a deep breath. Relax. This lesson will change the way you trade forever. What is market structure? Market structure is simply how price moves. Price always moves in waves. Up, down, and up, down. These waves create highs and lows. These highs and lows show you who is in control, buyers or sellers. If price keeps making higher highs and higher lows, buyers are winning. If price keeps making lower highs and lower lows, sellers are winning. If price moves sideways, no one is winning. This is the foundation of all trading strategies. Smart money, price action, Elliott wave, ICT, supply and demand. All of them begin with market structure. Without structure, you are trading blind. With structure, you become a confident and focused trader. The three types of market structure. 1. Uptrend, higher highs and higher lows. Picture price climbing stairs. Step up, a small step down. Step up, a small step down. That's an uptrend. Buyers are pushing price higher and protecting the lows. Key rule. If price continues making higher lows, buyers remain strong. 2. Downtrend, lower highs and lower lows. Now imagine walking downstairs. Step down, a small step up. Step down, a small step up. This is a downtrend. Sellers are pushing price lower. Key rule. Lower highs tell you sellers are controlling every move. 3. Range, sideways structure. This is when price goes nowhere. It bounces between support and resistance. This is where beginner accounts blow up. They enter too early, too late, and get trapped. Professionals wait for breakouts. Beginners get eaten alive inside ranges. Understanding these three structures will make the market feel 10 times simpler. How trends form, continue, and break. Trend formation. A trend begins with a simple shift. Uptrend starts when price makes the first higher high. Downtrend starts when price makes the first lower low. It is like a story beginning. Trend continuation. Trends are made of pullbacks. In an uptrend, price rises, then pulls back, then rises again. Each pullback creates a higher low. In a downtrend, price falls, then pulls back, then falls again. Each pullback creates a lower high. Your job as a trader. Trade in the direction of the trend, not against it. Trend break. Every trend eventually ends. An uptrend ends when price fails to create a new higher high, and instead makes a lower low. A downtrend ends when price fails to create a new lower low, and instead makes a higher high. This is called break of structure, BOS, or shift in market structure, SMS. This is where big opportunities start. Liquidity and structural traps. Now we go deeper. Markets do not move randomly. They move because price hunts liquidity. Liquidity is simply where traders place their stops. Example. Above a previous high, there are buy-side stops. Below a previous low, there are sell-side stops. Smart money uses structure to hunt these areas. Here's the trap. Price will often break a higher low just to grab stops. Then reverse in the opposite direction. This is why you must learn the difference. True break versus liquidity grab. A true break builds a new structure. A liquidity grab quickly returns back inside the range. Beginners lose money here. Professionals wait patiently and observe. Liquidity plus structure equals the real power of price action. How to identify structure in real time. Here is your simple 4-step process. Step 1. Identify the trend. Is it uptrend, downtrend, or range? Step 2. Mark major highs and lows. These are your anchor points. Step 3. Look for structure breaks. Break of structure, BOS, or CHOCH, change of character. Step 4. Predict the next move. After structure break. In an uptrend, wait for pullback to higher low. In a downtrend, wait for pullback to lower high. In a range, wait for breakout retest. If you follow these 4 steps, your trades become 10 times more accurate. Entries, exits and live examples. 1. The simple entry model. After structure shift. Price pulls back. Creates rejection. Shows continuation. You enter in trend direction. 2. Where to place stop loss. Below higher low in uptrend. Above lower high in downtrend. 3. Where to take profit. It is a moment when you reach the next structural high or low. 4. Example. Price was an uptrend, higher highs and higher lows. Suddenly price makes a lower low. Trend breaks. Price pulls back, forms lower high. Sellers appear. This is your entry. So you, my friend, you don't need indicators. You don't need signals. When you understand the structure, the chart becomes crystal clear. Market structure is not a tool. It is a superpower. When you master it, you stop being a beginner. You stop being emotional. You stop being confused. You finally see the market the way professionals see it. This is your trading foundation. Your anchor. Your compass. Study structure. Practice structure. Trust structure. Because when you understand the story behind the candles, you trade with confidence, not fear.